Thank you, Fred, and thank you all for coming. It's really a delight to be here at IAE. Thank you, Fred, for the introduction, and I'm grateful to be here and have such a good audience, and I'm grateful that the air conditioning here is as effective as it is. These are challenging times for the U.S. economy. You all know that. The economy is slowing in the wake of a significant downturn in the housing market, tenuous financial markets, and unprecedented commodity prices. And chief among the concerns of most American consumers is the dramatic rise in the price of oil. High oil prices are an enormous burden to American families, to the U.S. economy, as well as families and economies around the world. And further, the growing financial imbalances that Fred and many others have talked about, created by the flow of oil and money between consumers and producers, are both concerning and I believe unsustainable. In January of 2002, a barrel of oil cost about $20. By January of 2005, that price had more than doubled, and by January of this year, it had doubled again. Earlier this month, the price approached $150 per barrel. And more recently, as concerns about the slowdown of the global economy increased, and as fears of hurricane-related disruptions of oil production in the Gulf of Mexico dissipated, the price of oil dropped to its current level, which is just under $125 per barrel. Now, ladies and gentlemen, today I'd like to discuss why this dramatic increase in prices happened and what we should do about it. And simply put, the world economy, and with it the global demand for oil, has been growing rapidly, and the supply of oil has not kept pace. And in response, as all of you know, prices must rise to allocate this limited supply. And these long-term trends, despite what you read in the paper, are indisputable, and they are the primary drivers of the increases in oil prices. Now, our challenge is complicated by the fact that the difficulties we face in achieving a secure, stable, and cost-effective worldwide supply of energy are the flip side of the pressing need to address global climate change. There are no simple solutions to these deeply interconnected problems. But there are steps that policymakers can take now to put us on a path to a more sustainable supply of energy, low-cost energy, while reducing greenhouse gas emissions. And while my remarks today will focus on oil prices and the actions we should take on this front, and in achieving energy security more broadly, they can be and they must be consistent with our broader efforts to protect the planet. Now, on the demand side of the fundamental story, we start with what, by all counts, is a positive development. Global economic growth from 2002 through the end of last year was remarkably strong, averaging about 4.25% in real terms, and it was led by emerging markets like China and India. This not only benefited millions and hundreds of millions of people in these countries, but it also strengthened industrial economies like ours through access to dynamic, high-potential export markets. Most of the world's largest energy consumers are industrialized countries. But the growth in emerging markets has been accompanied by an increasing thirst for electricity and for automobiles, and the consequent extraordinary growth in the demand for oil. According to the U.S. Energy Information Administration, the EIA, global oil consumption jumped about 9 million barrels per day since 2001. With more than the lion's share of that increase concentrated in economies where the per capita consumption of oil is relatively low. Now, on the other side of this equation, global oil supply has not kept pace with this remarkable growth in the global economy and oil demand. Between 2002 and the present, the quantity of oil produced has risen at an average annual rate of about 2%. That's less than half the rate of growth in the global economy, and that rate of growth in the global economy is a pretty good proxy for the growth in demand of energy. With strong, the economics of the situation are clear. With strong growth in demand and sluggish increases in production, the price must go up to allocate the limited oil available. And that is exactly what we've seen over the past several years. Now, why has oil supply growth been so slow? Well, first, real investment in new capacity to produce oil has been weak around the world. Oil prices troughed after the Asian crisis in 1997, at one point going below $10 per barrel, as hard as that is to believe right now, $10 per barrel 11 years ago. At that price, there was minimal investment, capacity and workforces were cut, and spending on exploration dropped precipitously. In addition, the wave of nationalization of oil production and the increasing concentration of oil resources in global hotspots has reduced investment. Most oil fields take years to develop, and in some cases, a decade or longer. Because investment has been curtailed, we now barely have the oil needed to offset declining production in older fields, let alone increase production to meet new demand. And looking ahead, it is increasingly the case that oil reserves are located where it's geologically difficult to develop them, and where even greater investment is needed to tap into these resources. The second point is that oil fields go through a natural progression. They start up, they peak, and they slow down. And over the past few years, a number of major fields are producing significantly less. And that loss has to be made up simply to keep global production flat. So this story of rising demand and stagnant supply has steadily chipped away at global spare capacity. In the 1990s, spare capacity averaged about 4 million barrels per day. Over the last 5 years, however, spare capacity has averaged less than half that amount, and it's dropped even more dramatically as a share of global consumption. And it's into this mix we throw the third factor, the key factor that has affected the supply of oil, disruptions, or the perception of growing potential for disruptions resulting from events such as wars, civil turmoil, or hurricanes in the Gulf of Mexico. With little spare capacity to buffer against these events, these disruptions and the fear of possible future disruptions feed directly into higher prices. Now, turning to this year, expectations of supply and demand have changed significantly, and that accounts for most of the rapid run-up in price over the past 6 months. This development is explained by the fact that perceptions about future supply and demand can and do affect prices today. For example, suppose it becomes clear that there will be a significant decline in supply of oil 6 months from now. In that case, if you were a large consumer of oil, what would you do? Well, you'd likely buy as much oil as you could now to avoid paying that future higher price. Yet by buying extra oil now, you could motivate the very price increase you anticipated. This also works in reverse. Expected future increases in supply or future decline in demand, or some combination of the two, decrease the current price. Over the past year, the market has gradually factored in the realization that supply is not keeping up with demand. There was no one event that led to this realization, but a collection of small ones. Production delays for new oil fields, shortages in oil drilling equipment, the surprising resilience of emerging markets as the global economy has slowed, and growing geopolitical uncertainty in the Persian Gulf. These all change market perceptions about current and future oil supply and demand. We also see that even small changes in fundamentals can have large effects on prices, particularly in tight markets with a limited buffer between supply and demand. Again, back to basic economics. If supply falls by 1%, consumption must decline by an equal amount. That decline is brought about by an increase in price. Unfortunately, it's difficult to get people to reduce oil consumption because it's so fundamental to everything we do, and there are no close substitutes for it at present. Therefore, the price has to rise sharply to induce the necessary changes in consumption. We see this inelastic demand in current prices, and we feel its effects in our day-to-day lives. Now, so far, and despite their prominence in the news, I've not mentioned either speculation or currency depreciation. The reason's simple. The effects of these two factors are relatively minor in comparison to the changes in fundamentals that have been building up for a decade or longer. I'm not dismissing them completely, but I want to put them in the proper perspective. We must not let these concerns over second-order factors distract us from focusing our attention on the root causes of dramatic increases in price, a growing gap between the world's desire to consume oil and its capacity to produce it. Now, in oil futures markets, there are three types of participants. There are hedgers. These are market participants with commercial interest in oil, like oil companies or airlines, that need futures markets to offset the business risk that's created by volatile prices. There are investors, pension and index funds. These are typically funds that seek to diversify their assets with investments in commodities and who buy and hold for the longer term. And there are short-term investors, often referred to as speculators. These are market participants with no commercial interest in oil who bet on future changes in the price. Investors, whether focused on the long term or the short term, play a crucial role by supporting a large and liquid market that makes it easier and cheaper for hedgers to minimize their business risk. Of course, there are well-documented examples of how small groups of investors have cornered markets in the past by hoarding physical commodities. This behavior is better known as manipulation, and it's rightly illegal. The Commodities and Futures Trading Commission, the CFTC, routinely polices markets, and it prosecutes such manipulation, and currently there is no evidence of hoarding. According to the EIA, inventories in the United States and industrial countries more generally are falling. Moreover, the CFTC's market monitoring shows that the net positions of short-term investors have not grown relative to the overall market over the past 2 years, precisely at a time when they are being accused of causing the prices of oil to soar. Now, short-term investors can move prices, sometimes in a good way, like when they quickly move the market to incorporate the latest information, and sometimes in a bad way, when they get caught having to buy back large bets on price swings that don't materialize, sometimes referred to as short squeezes. Clearly, they can contribute in this way to volatility in prices that we have seen in recent months. However, by creating a large and liquid market, they also help reduce volatility. And over the long haul, short-term investors do not systematically move prices away from the levels dictated by the fundamentals of supply and demand. Some also assert that investors pouring money into oil future contracts are driving up prices. Once again, however, there is little evidence to suggest that investment flows into futures are causing the rise in the price of oil. For example, the prices of other commodities for which there are no futures markets and in which these funds are not investing have also risen as much or more than the price of oil. And as with oil, global demand for these commodities has increased dramatically while the supply has not kept pace. Fundamentals, not investment flows, are driving increases in these commodity prices and in oil. Similarly, the effect of the depreciation of the dollar on oil prices is relatively small. The price of oil has soared regardless of the currency in which it's quoted. For example, since 2002, the euro price of oil has shot up about 250%, and the yen price jumped up by 400%. Further, in the past 120 days, the price of oil has risen as much as 30%, now back to about 20%, while the real value of the dollar during that time has changed very little. It's true that the decline in the value of the dollar could result in higher demand for oil in those countries whose currencies appreciate against the dollar. Everything else being equal, the price of oil in their local currency is cheaper, and therefore that could stimulate demand. However, over the last 2 years, the consumption of oil in Europe, for example, has been flat, despite a strong appreciation of the euro against the dollar, suggesting that there are other factors that are more important in this case than currency movements. Now, in many ways, I wish the problems we face were as straightforward as speculation or currency depreciation. Unfortunately, we've got a more complex challenge. In addressing long-term trends in supply and demand, there are no easy solutions. We must take significant, credible, and comprehensive action today to change the dynamics of energy supply and demand for the longer term. And such steps will not only help over time to resolve the gap between supply and demand, but they'll also result in lower prices in the present. First, we must understand this rapidly changing market. Efforts to study the dynamics of the oil market are already underway. The International Energy Agency and the IMF have been charged by the G8 finance ministers to dig deeply into the root causes of this problem. Similarly, the interim CFTC report released last week and the final study to be released in September are an important contribution to this debate. There are also much needed efforts underway to improve the availability of financial data, data on the financial flows into oil futures markets, oil inventories, and proven reserves. Better data and more transparency will greatly reduce the uncertainty that's contributed to higher prices. Second, in terms of supply, we must cultivate an open investment climate at home and abroad through bilateral investment treaties, free trade agreements, and pro-investment policies. Greater investment in oil production and refining capacity, as well as alternative sources of energy, is urgently required. Production in key countries, such as Mexico and Russia and Venezuela, is declining, and the vast majority of the world's oil reserves are nationally owned, and 1/3 of all reserves are in countries that allow no foreign investment. Policies that restrict market access deny these markets much-needed capital, know-how, cutting-edge technology, and entrepreneurism. We also need to invest more within our borders, and we need to do so in an environmentally sustainable way. A few weeks ago, the President lifted the executive ban on exploration of the outer continental shelf, and he called for America to do its part by increasing the global supply of oil, by increasing domestic exploration, leasing oil shale on federal lands, and streamlining the refinery permitting process. These measures have the possibility of increasing domestic supply, and they also bring far greater credibility to our efforts to encourage increased production overseas. But we must also pursue energy diversification by increasing investment in alternative sources of energy in the United States and around the world. In this regard, the government can play an important role by supporting basic research on critical technologies and by creating market incentives for the private sector to develop and rapidly deploy alternative energy sources. Under President Bush's leadership, the United States has made real progress in this area. Since 2001, we've spent more than $12 billion to research, develop, and promote alternative energy sources. And similarly, as a result of the President's renewable fuels mandate, use of these types of fuels is projected to exceed 8% of U.S. gasoline supply by 2015, more than double the 4% that it is today. Now, of course, with the price of oil at roughly $125 per barrel, the private sector also has every incentive to invest in alternative energy. And here we already see market forces at work. For example, electric cars are actually being produced now by several startup companies, and established U.S. automobile manufacturers plan to introduce their own electric vehicles by 2010. Given the magnitude of this challenge, we and other nations must accelerate our efforts to develop and deploy these game-changing technologies, such as modern, safe nuclear facilities, wind power, and carbon capture and sequestration. All of these are at the cusp of widespread commercialization. Third, we must take steps to stem global oil demand. To this end, the President has implemented the first significant increase in car fuel economy standards in more than 2 decades. We can also work to better educate consumers on how they can conserve and how they can make energy conservation a fiscal and social priority. For example, in response to high fuel prices, a recent Gallup poll indicated that 80% of Americans are taking steps to cut back on their daily driving. And we already see the effect in a 4% decline in U.S. gasoline consumption this year. That's compared to what's been on average over recent years, a 3% increase. Also on the demand side, we should ensure that critical price signals are not obscured by subsidies. Currently, over 50% of the world's population has access to subsidized fuel, and 22% of all gasoline purchases are subsidized. Now, we don't expect countries to remove their subsidies altogether tomorrow, and we welcome the steps that some countries like China and India have already taken. But the countries that subsidize need to develop a plan to eliminate subsidies over time. Just formulating and beginning to implement a credible plan could impact current oil prices. And not only will such efforts result in greater market transparency that will allow price signals to lower global demand, but they will also remove a significant economic burden on governments to subsidize, allowing them to dedicate more resources to more productive purposes. These are just a few. The list of the potential policy options is long, and I've only highlighted a few of the many that should be pursued. Ultimately, a complete package of actions must be taken by energy producers and consumers alike to reduce oil consumption, increase the diversity of energy supply, and to put prices on a lower and more stable trajectory. Ladies and gentlemen, we face a great challenge, but in this country, we are no strangers to adversity. Addressing it will require new investment, new innovation, and significant changes in how we consume and conserve energy, but in a way that maintains the vibrancy of the U.S. economy. Because the dramatic rise in the cost of oil is a global dilemma, it is one that we must tackle in concert with others. Affordable, environmentally sound, and economically sustainable energy supply is in the interest of the entire global community, producers and consumers, developed countries, and those developing. Success will require us to take tangible, credible, and significant steps to address the fundamentals of supply and demand, and to do so in a way that substantially reduces global carbon emissions in the coming decades. To overcome this enormous challenge, Americans must do what we've always done: adapt, innovate, persevere, and prevail. And I'm confident that we're up to that task. Thank you, and I'd be happy to take your questions.